Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Sean Udall on. He's better known as the Tech Stock Strategist. He joins us to give us his insight into the markets. Sean, how you doing on this Wednesday morning?
I'm just fine. How are you guys?
We're doing good, doing good. Got a good show going, about to get better. Want to talk a little bit about Twitter. I know it's a stock that you've been talking about for a long time and building a major position in it. And I was just wondering, ahead of earnings, when you have a big position in something, do you try and take some off or try and get some protection? Especially if you have a lead on it. Generally, what's your approach?
Yeah, I almost always take some off. I mean, I either, well, better said, I either take some off or I put hedges on. And I mean, in hindsight being 2020, I wish I would have done some hedges. I mean, the thing that actually messed me up is, frankly, I do a lot of put spread hedges. And frankly, I was probably going to do one on Twitter because a lot of times I like to do those in the last hour or two of trading, and that Twitter leak actually messed me up pretty bad. But
yep.
Oh yeah, no, I mean I had, in fact, I bought some Apple puts right before they reported. So it's not uncommon at all for me to hedge anywhere from a quarter to a third of my position. So with exactly with Twitter, I mean, I'd probably sold. I hadn't quite sold a third. I mean, the thing is, if you remember, I mean, you guys have been talking to me, for quite a while now. I mean, I was buying stock in the 30s, in fact, in the low 30s. So Twitter at 51 to 53 I was sitting on a pretty big gain. So I'd been trimming some already. And then before earnings, I think my plan was to trim like a third. Again, I kind of got messed up. But I had probably sold about a quarter of it. Hindsight being what it is, the most I would have sold is half. Because when I like a position, I hold through earnings, and I might hold through earnings for 4 or 5 quarters in a row. So one bad quarter is not going to knock me out of the position. But that leak did mess me up because in fact, I know I was looking, I believe, at the 48.43 or the 48.41 put spread or something like that. And, I was going to do some. I don't know how much, but I was going to do some.
And then that leak came in. Yeah.
Definitely cost me thousands of dollars.
All right, so now, yeah, that's interesting. I guess that maybe learn a little lesson from that one and put them on a day early. I know you don't want to pay the extra premium.
I might just do that, or in the morning or something like. But see, there's a volatility component too, which we don't have to get into. But there are a lot of times where actually putting some protection on actually just pricing wise works, because what will happen is people will pump the call premium up and the put premium gets cheaper right before an earnings report, especially when a relatively good report is expected, right? So anyway, won't get it. So in other words, if I'm ahead of earnings, if I want call exposure, I'll try to buy those days, a week to 2 weeks in front of the report, because volatility will increase. I might get a gain just on volatility rising, right? So without getting too in the weeds, there actually are some structural reasons to kind of wait to do puts sometimes, not all the time, but sometimes.
Yeah, see, I mean, you had no way of forecasting that. So you had the big washout here, takes out a lot of your profit. Do you throw in the towel? Do you liquidate the rest of the position, or do you get aggressive and still get active in the issue?
Oh yeah, no way. I mean, this is, in fact, so great case in point. This is basically trip number 3 on Twitter. So, the first time I went into the low 30s, I built a position. In fact, that was the first time I built a position up. But more important than building a position up, you can catch 10, 20, 30, 40 trades, while the stock is cheap and while it's trading, what I call in a volatility channel. Now, here's the only thing I don't want to have happen with Twitter, and it didn't do this before. What sucks is when a stock goes down, gets hit hard, and then just dies, right? It just ceases to trade. I don't think Twitter is going to act like that, because the big stocks with larger market caps, and especially if they're kind of battleground stocks, they tend to have pretty good trading volatility once they get beaten up. And that's what Twitter was. I mean, Twitter went from the first time it hit 30, it went from 30 back to, I want to say, 55. The second time, it was just people forget, just in December of last year, Twitter got as low as 34, 35. That was spectacular. That was a great trading move from 34, 35 to 50. And here we are again. frankly, the company is not much different than it was. I mean, that earnings report, it really wasn't that bad. I mean, if you really just look at the facts, they lowered the full year guide by 5 to 6%, and they've taken over 30% out of the stock. Now, they probably should, hey, on even a 5% guide lower, they should take 10%, 15% of the stock. But if you ask me, I mean, they basically took 2x out of the stock more than they should have. Worst case, I think the stock should be down 15%, and it's down 30%. So I feel pretty confident that I'll try. Again, I'm going to trade at 10, 15, 20, 30, 40 times. Let's just say you get 31 to 2-point trades on Twitter. 30 times 2, 60 points. So you can theoretically work yourself into a zero cost basis on a stock if you trade it fairly well.
Okay, let's do some previewing here. Alibaba smashed through $80 yesterday. Quad bottom there, took it out, went to 77, 77. Bounced back up, trying to get its head back over 80. Earnings tonight. What are your metrics saying on Alibaba?
I would say that at this point, the setup for earnings to be long is pretty good because there's just been so many weird little pieces of bad news, whether it's the hiring freeze, whether it's some controversy with having to pull fake goods off the site, all sorts of stuff going on, right? From a valuation perspective, now remember, I did not like Alibaba. When everybody else loved it from, the $110, $120 price, I'm like, I'm not touching that thing. And I was short the name a few times. So you take 40 points out of the stock, it becomes a lot more attractive to me. There's a very good chance, I'd say 75% chance I'll be long into the print, but small. This is not something I want to do big. In fact, this might be a good kind of, for me, kind of a good call spread type structure where I don't outlay very much money, but I have some upside exposure. I don't mind having a little bit of the stock, by the way, kind of long term. It is very, very cheap here. If you believe the numbers, which I do, it's very, very cheap. And again, the 40-point haircut makes the stock a lot more attractive. So, I mean, the funny thing about tech, and again, this is basically a tech. It's kind of a consumer brand, but you can throw it in the tech bucket. If you wait for everything to look good to buy tech, you'll never make money. So there are some things at Disney you can probably buy on technicals, and you can probably pay, if you paid 52-week highs 5 years ago, you're okay today, right? Now, and they're the leading global brand. Apple's worked that way, but like Google. I mean, if you bought Google at a 52-week high time and time again, you probably haven't made much money in that stock. You might even not be up much right now. But if you bought Google when everybody else is puke selling the name and nobody likes it, and for whatever reason they get disenchanted with it, you might have made 100, 200, 300% trading Google. So you just kind of have to know your sectors and kind of know. I mean, in a lot of ways, tech is like oil, and tech is like a cyclical deal. You kind of got to buy these things when everybody else is running for the hills. But Alibaba, I don't mind. I don't love it. It's not one of my favorite names, but there's no way I'd be short Baba going into this print.
Tesla Motors here has had a nice run up, going into a different area with the energy storage. What's your thoughts on Tesla?
Well, that's exactly. So I've actually talked to your guy Lewis over there a number of times, and this is exactly what Tesla needs to do to justify their market cap. So the problem is, to me, them getting into battery storage, great market for them. They'll probably be strong at it. But this sort of gets them to probably where my problem with Tesla is, to me, it's fairly valued because I think they're kind of going to struggle with some of the auto results and some of the auto numbers until they get that crossover product out, and maybe we see sales volumes increase again. But sales volumes haven't been real good. So the bears can kind of pick on it on that because, the real numbers coming through aren't that good. The battery's still a ways away. However, this is another good example. I mean, I was, you'd probably give me 25 to 40 points lower. I'm pretty interested in the stock. If right here or above, I don't know if I'd short it, but I'm basically in no position on it right now. But I think the battery deal is what they need to do, and a thing that could justify the current market cap of the stock at $30 billion, and eventually make that market cap rise.
Okay, we know you've been playing the cybersecurity stocks. FireEye got a nice boost here. Got up to the resistance 45. You talked about that level. Were you looking for more out of it? Or are you still hanging in there?
No, that's about where I thought. I thought it might break through, but so here, this is it. In fact, I bought some FireEye right, pretty low yesterday. So not right at the close, but pretty close to it, and I'll probably build it. The only reason FireEye went down, you had, obviously the market getting crushed for a couple days, but that Qualsys, and Qualsys is a name I did like. So I liked FireEye, I didn't like Qualsys. In retrospect, I should have been short Qualsys. I wasn't. But the bottom line is, this is exactly. I mean, hey, the stock was just at 44 a day and a half ago, maybe even 45. They took almost 10% out of it. They finally had that quarter that everybody's been wanting. So they beat on revenues. The guide was better. My number key for FireEye was billions. And the current billings and the forward billings are better. And frankly, it's one of the cheaper stocks in that space. People don't think it is, but the people that say that don't really look at the numbers very carefully, because it trades at, God, I mean, it might even be more than a 50% discount to Palo Alto Network. So, by the way, CyberArk is coming. I'm tempted, but I think the highest I've ever paid for that stock is between 55 and 57, and I've bought CyberArk in the mid to low 30s. So. At $60, I'm not sure I'm going to have a position, but I do think they will report very strongly. So in a really strong report of the CyberArk, and if people start chasing that again, I think that should help FireEye. So I think the setup for FireEye is good. It's pulled back $5, it's $4 to $5, and CyberArk's going to report. The report should be good, and then we still have Palo Alto Networks in front of us. So no, this is exactly the space. In fact, I'll probably be pretty active. I'm probably the most active trading Twitter right now. I'm probably going to become the second most active trading FireEye to the upside.
And why did you like Qualsys?
I didn't like Qualsys.
No, I just said why didn't you like it?
Yeah, it's a single product kind of seller. So they don't have a broad product portfolio like FireEye and Palo Alto. But it's really just my valuation matrix. So. I'm trying to remember the last time I actually kind of liked that name. I mean, it was probably a good 20 points lower. So I mean, here's a funny thing. The market's the ultimate. What does Warren Buffett say? The market's the ultimate weighing machine, or something like that. It just Qualsys didn't make any sense at $55. Here's the funny thing. Even if they had beat and had guided slightly higher or something, the stock still probably would have come down 15%. So they actually missed. So the stock went down more than double that. And the miss wasn't like a Twitter miss. The miss was a little bit worse. So, now at 37, it maybe. I mean, you'd have to give me kind of 35 or below to get me interested in this name. But yeah, I just, it was pretty overvalued. I'm not going to say it was a bubble type valuation, but it was very, very overvalued. And similar valuation to a Palo Alto Network. So, the risk of Palo Alto, by the way, is, again, I'm not going to be short Palo Alto, although I might. It's if they have any misstep at all. You could see 25 to 50 points come out of Palo Alto. Now, it's very likely that they're like Floyd Mayweather, and they're gonna beat the odds, and it's highly favored that they're gonna win the fight, so to speak. So a good earnings report is very, very much expected of them. But man, they have to deliver. If they just sort of beat and have an inline guide, I don't know if the stock can keep trading where it is. So that's basically Qualsys, and Qualsys doesn't have near the breadth of the product portfolio of FireEye, Palo Alto, or the old guard like Checkpoint Software or something like that.
When's Palo Alto report?
I don't know that off the top of my head, but I think it's just a week away.
Okay. We got to get a Ringcentral update. You still
yeah. Still like it, still have it, so here's the difference with Ring now. I think nobody would have thought that sort of my $20 to $25 deal was rational when the stock was at $10 to $12. Oh, look, Ringcentral is $17 now. And guess what? Now people are starting to say, hey, this thing might be worth 22 plus. So but by the way, this is the same. Twitter's valuation in my mind, hasn't changed. So you want a great example of what why Twitter just might work over time, because things like Ringcentral end up regressing to the valuation they should trade at. Now, that's maybe a tougher trade for some people, but it's easier trade for me. But yeah, 17, I think is now I don't like it as much as the stock is up 70% from some of my best purchases of it. There's no way I can like it as much now as I did at 10 to 12. But, I still think it's good for 22-ish, something maybe even 25. And they have a nice position and are growing. And, they had a great quarter, by the way. In fact, the stock hasn't moved off their report at all. And I think it's probably due, a lot of the mid and small cap stocks have been getting beaten up in the market. So I think it's just that kind of the market angst we have right now is kind of holding it back. But if we get to a point where the market just starts kind of lifting all boats again, where the market starts lifting all boats, I think Ringcentral, could kind of gravitate pretty easily 10 to 20% northward.
Okay, before we let you go, Sean, I know you have a couple different theories on the overall market, and you've been maintaining a bullish thesis. You just want to lay that out for us.
Yeah, well, the most basic bullish thesis, and I think the thing people miss, and you and I have exchanged a couple notes on this, is, okay, I'm just going to ask you 3 questions. Okay, is the Fed still stimulative at 75 basis points? Yes or no?
I'm sorry, yes.
Okay, you didn't answer, but so the Fed would still be stimulative at 75 basis points, right? Would the Fed still be stimulative at 1 to 1.5%?
Yes.
Again, I won't do the quiz thing. Yeah, there you go. Now, would the Fed still be stimulative at 2.5%? That's a tougher.
Yep.
I still say yes historically, but in this environment, probably not. So to me, as long as the Fed doesn't raise rates to 250, they're still hyper stimulative. Anything between 50 basis points and 150, which is where I think the Fed will settle in the next 2 or 3 years. I think whenever they're done raising rates, like the high end of the next rate hike cycle might be 1.25% or might be 1.5%. That's not just stimulative. That's hyper stimulative, right?
And you made the point too. You made the point too that even after you start to raise interest rates, sometimes the market still goes up for a couple of years.
Well, that's right. If you just sort of look at any, just pull up go to the Fed.gov. I'm trying to think it's the Fred database, and you literally can look at all the Fed rate hike cycles. I think going down literally to the beginning of the Fed, and then you can plot an S&P chart over top of that. There's very few times. There might be one time in history where the first sort of 1 to 2 years of Fed rate hike cycle actually isn't one of the stronger periods for stocks. Now, it's a period of increasing volatility, which we're kind of seeing right now. And there's usually, in fact, if anything, usually there's some wiggles and some corrections before they raise rates. But here's my mantra. I think we could try to trade kind of dicey and kind of junky and this weird chop trading, which feels bearish but is kind of sideways. I think we might trade like this and actually until we get the Fed rate hike. And then once we get whatever it is, if it's at 15 basis points or 25 or whatever, I think once they finally hike rates, that might be the catalyst that actually sends the market higher. But anyway, the bottom line is, as long as the Fed doesn't overshoot, and I think the overshoot level of lower, used to be about 400 basis points from wherever the Fed was. So if the Fed lowered rates from 7% to 3%, and they went back up from 3 to 7%, then they'd overshot, right? Or if the Fed lowered rates from wherever to 1.5% and then went back up to 550, boom. In fact, 550 was the overshoot in 2007, right? So I think as long as I think the new overshoot is 250 basis points instead of 400 basis points. So I think as long as the Fed doesn't raise rates more than 250 basis points, there's still just a ton of stimulus. Now, that doesn't mean you can't be as bullish at NASDAQ 5,000 as you were at NASDAQ 1,500. But I think you can kind of just parse the market and say, what is economic activity going to look like? What is stimulus going to look like? What is, what might stock prices do? By the way, Warren Buffett just came out the other day. He was on CNBC and he said, hey, if interest rates stay this low for a lot longer, stocks are ridiculously cheap. If interest rates were to go up a ton from here, stocks might become pretty expensive. But, there you go. Again, we were exchanging some notes, and we both said the same thing. We don't think there's any, you and I meaning, we don't think there's any way the Fed's going to get to 250. I think max the Fed's the chicken right now. The Fed might maybe get to 150, and it might take them 2 or 3 years to get there. So, that's the thing I think people just sort of forget. And, oh, by the way, we have the EU at 0 now, and we have all these other. In fact, if anything, the EU didn't even need to do QE. and but they're doing it. They finally did it, and so we'll see what happens. Again, that's why I kind of have this theory that we could see a 1998, 1999 mini version of it. Again, I think we're seeing it in the biotech sector. I think we've seen some froth in some other places. I mean, in the spring of 2014, without getting too long-winded, there was a lot like
Sean, I'm
small cap,
sorry.
mid-cap,
I'm
go
running
ahead.
over here. I'm running over in my
No,
time.
you go. You
and we
go.
got a next guest on hold, but I'll catch up with you later today.
No, go it.
All right, sorry. All right, bye-bye.